Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, August 11th, 2017. Wanted to do two videos on the semiconductor stocks here. Yeah, this will be part one. I've covered these quite extensively lately, and again, the reason I'm doing that, and I've been warning this for a while, this is and we're looking at an impending correction or bear market in the semis. Now, whether that happens in the next day or two, no, today's Friday. Whether that's already started with the highs here back in June, or we could continue on for a few more weeks, months. We all know that nothing goes up forever, and I'll go over the history of the charts here in a second. So this part one video is the simple version. It'll probably cover most traders. If you don't care to trade individual stocks, and you prefer the relative safety of ETFs, then this is your video. I'm also wanted to talk on a premise that applies to not just trading these semiconductor ETFs, but all. I want to talk on the leveraged ETFs as an option for trading these. And again, that conversation will apply to any leveraged ETF. I think there's a lot of misconception, misunderstanding. There's a lot of negative PR about holding a leverage ETF for anything more than an intraday trade. Um, for the most part, as a general rule, yeah, I think that's safe to say that they're very lousy investments if held over an extended period of time, meaning more than a few days or a few weeks or a few months. Um, so I'll go over that and I'll go over the charts of what I'm looking at in the semiconductor sector. And again, if I didn't think there wasn't a tremendous opportunity, we're not there yet. We're possibly very close, as I mentioned, but I'll go over what I'm looking for as far as confirmation, some high probability sell signals. And let's start out here. Just going over that premise because we have a couple ways to trade the semis if you're going to stick with ETFs. You have SOXX, which trades the PHLX SOX Semiconductor Index Fund. And we'll look at the actual index itself, but it will roughly mirror that. This one tracks pretty well. And then you have a few other companies out there, VanEck, Vectors Semiconductor ETF, and then XSD. So if you've watched any of my videos or seen my analysis, I like to follow all three of these. Why not? If you're tracking a sector, yeah, they have different, mostly the same components, I should say. There's a lot of overlap. They're all semiconductor related stocks, but they'll have different weightings. Some will be excluded out of one ETF, not the other. And so you can trade any of these. But when trying to call a top or a near top on any strong trend, or whether it's a downtrend or an uptrend, you want overwhelming evidence because as this market's proved, earlier a few months back, earlier in the year, I took a shot on the semis on the short side. That trade was stopped out, and they continued to go up. Some of those we actually did hit our profit targets. So it was a pretty decent pullback in a lot of the individual stocks. And please don't ever confuse swing trading with long-term buy and hold investing, especially on the short side. During the next bear market, if and when that, well, I should say when that comes, there'll be plenty of opportunities to short something and then throw away the key. Put your stops in place so you don't lose if wrong, but then let it ride and go for the big gains, high double digit gains on the short side. But and then there have been sectors within the financial markets, commodities, gold stocks a couple of years ago, other things that that you could have profited well as the stock market was going up. All right, let's not get off on a tangent here. I wanted to show, talk about the different vehicles besides those three companies that I just mentioned, SOXX, XSD, and SMH. We have a couple options as well. If you want to use leverage, you have SOXL. Now, these leveraged ETFs are semiconductor index tracking ETFs that use 300 times leverage. So you're going to have three times a move, and they track the same index as does SOXX, that PHLX SOX Semiconductor Index. So that's very important that you know if you're trading a leveraged ETF, you need to know which underlying index. Because, for example, in the biotechs, you have the biotech long and short three-time leverage ETFs. They track the same index as XBI, not IBB and not PBE, which are two other biotech ETFs. So therefore, if you want to use, I like to use the charts of the one-time index, the actual index itself, or the underlying one-time non-leverage ETF when charting, if trading those 3 times. And so therefore, it's very important that you're comparing apples to apples when you're charting and trying to get confirmation on the 3 time leverage. So, okay, where am I going with this? 3 time leverage ETFs, although in, at the wrong time and the wrong securities, which tends to be actually most of the time, they are bad long-term investments, especially to hold, on the long side because of that decay. And again, you can read up on that in the FAQ page. However, there have been quite a few instances in the last few years. Gold mining stocks, for example, the semis, and I'm going to go over that right now, where if you can position yourself in what I refer to as a fairly unidirectional trend. By that, I mean this is a fairly unidirectional trend. Sure, there was some chops, some corrections along the way, but you can see the trend line. That's a straight, nice, gentle, straight, even slope up. Not a straight ascent, of course, but that's a clear uptrend with its pullbacks along the way. You look at something like crude oil in the last few years, you can see a choppy, messy sideways trend. A leverage ETF in crude oil, even if crude has gone nowhere in the last couple of years, you would have lost money on the long or short ones because of the decay. You don't want to be in a choppy sideways market. However, let's get into the statistics here and take a look. Let me find a clean board. SOXX, which again that tracks the one time the underlying index, since the bottom, sure, there was a lower low back here, but this is really where that trend took off. So I'm going to look at that and just use an example here. Now I've already done the math. I have to grab the bottom of that candle exactly, and that's hard to do without zooming in. I can tell you I've already done it, so disregard what you see to the left. It's showing roughly there. It says 105. So I came up with 108%. So from early January or early February 2016 up until the peak so far, and there's a lot of evidence I talked on that could be the top of the bull run. We had about 108% gain. Okay, so now let's look at SOXL, which is the 3 time leverage ETF. Okay, all other things being equal, assuming there was no decay, and sometimes when I do the screen recording software, it slows the loading of those charts. There it is. We have it now. All right. So all other things being equal, one would think that you'd be up about 300% or 324%. Because remember, SOXX went up 108%. So 3 times that would be a 324. However, because it was a straight, roughly unidirectional trend all the way, the gain was about 661%. Yes, that is correct. 661%, or over 6 times the leverage, or 600% the returns of, or 6 times, I should say, the returns of the non-leverage ETF. And that is because, again, I addressed that in the FAQ page, the math works for you, not against you, when you're using a leverage ETF and you catch a strong trend. And remember, as I often say, stocks tend to fall much faster than they rise. So when the next bear market comes in the semis, and I'll make the case that there's a lot of meat on that bone, the profit opportunities will be tremendous. And I don't think you'll have a problem using SOXX. But again, we're going to have evidence because this trend has been really strong. Here's the chart of SOXX from that same time period. To just continue on that point, the 3 time bearish semiconductor ETF fell about 92%. So basically, if you put in, and tucked it away and held, you had 100,000 to begin with, you'd only have about $8,000 left. You would have lost nearly all your money, 92%. And again, that's more than the 108%, inverse 3 times of the 108% upside of the SOXX. So therefore, again, point I want to impress, these trends are strong. Now, if you don't want to buy and hold a 3 time leverage ETF, what I do sometimes, I'll short the bullish one. So if I want to go short the semis, and I think it's going to be a trend and it might chop around for a while and there may be some decay, or I just prefer not to hold one of those long, you could short this thing and do just as well. Where it's going to backfire is if, let's say, you were to short the semis and use one of these leverage ETFs and the sector trades sideways for a year or so, chops a lot of back and forth. That's where the decay sets in. Now, once again, that decay can be to your advantage if you short SOXL, the bullish ETF, instead of going long SOXS, the bearish ETF. But a lot of you don't have margin counts, or if you do, you might want to, maybe you want some exposure in an IRA or some type of account that you're not able to short in, or your broker doesn't have shares to short. You can always go long SOXX. So that's the point I tried to impress. It's a huge difference on this run. Again, you made 600 had you, again, this is hypothetically speaking, and you bought the lows and sold the highs, but I wanted to really just point out the math, that the math works in your favor. 666% gain versus 108% gain in the one-time leverage during that run. And so if we see anything close to what I'm expecting in the coming months to year or so in the semiconductor stocks, and I'll get into that here in a second, the gain potential for SOXS, the three-time bearish ETF, can be really nice. All right, so let's look at the charts and we'll go from there. Okay, we'll start out here with just a quick overview of the PhilX Semiconductor Sector Index. So this is the actual index that SOXX, the non-leverage ETF, tracks. And so here's a look. This is a weekly chart spanning 10 years, and you can see this one pretty much works its way up in these pretty clear uptrend lines followed by corrections. I use log scaling, so it may not look like much, but the corrections on these trend line breaks are quite substantial, as are the rallies on the uptrend. So let's just look back here. It doesn't look like much, again, due to log scaling, but that was a drop of over 25% or so. This one from top to bottom in just, I don't know, 6-8 months, about a 33% drop. Again, that was on that minor trend line break there. And if you look at what I have down here on the RSI, now, so keep in mind, ideally you want to have two things occur, if not three. Three or better. The things I look for are, number one, trend line breaks. Look for a well-defined trend line with a few, at least a few reactions. The more reactions, the better. And you look for a breakdown. And ideally, you look for impulsive selling, big red candles like you see here on all these trend line breaks. See all the impulsive price action following. That's what you want to look for. So that's number one, a break of a trend line. Number two, if a trend line breaks and it's early on, that you might be able to have drawn some pretty shallow trend lines here somewhere along the line. But what I like to see are overbought readings on the RSI. And as I often talk about, during an uptrend, a primary uptrend, a bull market, overbought in itself is not a sell signal. Far from it, because overbought often becomes more overbought. Once you cross that 70 level, you tend to go higher, or you have a period of a cluster of you know, persistent overbought readings. We might hit overbought, come back in, stayed above the 50 level. So these are three consecutive overbought readings. So an extended period of overbought conditions, and finally prices have come, broke down, and then we had that 25+% correction. Once again, we're overbought here when that trend line break occurred. So, it's pretty simple. That's what I'm looking for. Overbought with trend line breaks, and I was measuring the losses from highs to low. You're not always going to get the highs, but even if you waited for the trend line breaks, there was plenty of opportunity there. The other thing I like to look for are divergent highs. So you can see, the overbought conditions. This one, you had divergence here, negative divergence. You had negative divergence on the PPO, and that was the third condition I was going to mention. I would like to see, and again, trading off the weekly time frame, or really even if you go down to the daily time frame. So number one, first and foremost, is price action, and that's a break of a trend line. Second is, does that occur after an extended run up where prices tend to get ahead of themselves, overbought conditions? And third, ideally, if you can confirm that with negative divergence, you didn't have it right here. If I drew a little line here, there was a slight divergence on the RSI. You can see it making a lower lower high there, and you had a slight, very small divergence there, and you still got a pretty sharp correction. So those are the things I look for. Now let's talk about today. We have the most persistent and extreme overbought conditions that we've had in at least a decade. Again, this chart goes back just a decade here. It spans the entire bull market that we're in. So number one, this tells me that when we get a correction, it's going to probably be pretty big because we've gotten way ahead of ourselves. Um, let's just take a look at what the SOX does. Now the rally that we've had recently is, I have to grab right over here. Oops, get rid of that box. I need my measuring tool. Okay, the rally that we've had, and I'm just going to try to grab at this level here. I'll have to move that trend line where I can go over here and just put my cursor at that level and measure up. We gained about 111% on this leg up right here. And that's about a run-of-the-mill, bull market run. This one was 147%. That came after the bear market lows back in '08. That's when the semis bottomed in '08. Some going from lows to highs. And then here we had a big triangle pattern. We finally broke to the upside. That was bullish. I pointed that out way back when on the site. Wish I would have just tucked semis away and held them, but anyways, in this case, I'm looking for swing trading ops. 108%. So there it is. So that last one was 108%, and that's about where we are right now. We're a little bit above that. So I wanted to make that point that this has just been as impressive as it seems. It's a run-of-the-mill bull market, and it'll probably be followed by a typical correction. That last one, here, I'll have to move that line. If I grab that high point there, go down, we had a correction of about 20, 29, almost 30%. And I expect nothing less than that going forward. So let's look at the charts here. This will kind of give you an idea. Let's go to SOXX. Let's look at what we'll be trading. That's one chart. You can see some price targets down here. I think at least T2 is where we're going. And from where we're at right now, you're looking at a drop of about 22% or so. Let's look at a couple other charts. This is a little bit more clear. Forget about the one I just showed you. Here's that trend line I've been watching on SOXX. I posted it yesterday. We actually closed right on it yesterday, went down below today. Even though the semis are trading up a little, we're back testing from below. Now, this isn't an impulsive breakdown. One of the criteria I like to watch, especially since this trend has been very resilient, you want to see an impulsive breakdown. I could even tighten that trend line up. I just noticed there. Yeah, if I tighten that up, we actually did break down yesterday, and that was an impulsive candle. So I should clarify, as I'm doing this video, I didn't see I wasn't tight to these candles here on my trend line. So yesterday was a breakdown, and today is simply a back test so far. So let's see what happens there. Let me put my volume bars back up here. Yeah, you can see pretty high volume, not super high on that volume bar yesterday, but we broke down. Need to see a little bit more evidence. It's not a very convincing or very impulsive breakdown, although yesterday's move down was impulsive. We only closed slightly below the trend line. I like to see a clear, solid break. So we're back testing now. This one's on watch. This is support here. I think we could see a reaction there about 138.90, but I wanted to just try to gauge how far I think the semis are poised to fall. And again, do the math with the 3-time leverage ETFs. If it's a pretty swift move down, corrections usually are. Stocks tend to fall a lot faster than I think SOXS will do very well. And in just the index itself, we're looking at about a 15-16% drop to that target there. And this is my preferred target. I don't think it'll be a straight shot, but I think we work our way down there. So I'm looking at about a 21% drop. So you can look for easily, if it plays out the way I think it is, that would be at least 60% gain on SOXS if it gets down there. And if it does it very quickly, you're compounding at 300%. So you could easily be looking at a 100% triple-digit gain on SOXS, the 3-time leverage. All right, so that's one of the 3 tracking semiconductor ETFs that I'm watching. Here's another one, SMH, And you can see the same story. I just updated these yesterday. Nice, nice trend line working its way up from the lows. And yesterday, same story. We just closed right about on the trend line, and we're about back testing today. So this still has, look, I'm going to look at it both ways. We still have the potential for yesterday's moves just to be a brief overshoot or a whipsaw signal. And as I made very clear, I want to see all three of these break. The other one is XS. Oh, before I leave SMH, let me just show you the target's also confirmed. There's actually about a 15% downside on SMH, and then XSD is the other one. This one already broke below its uptrend line, had an impulsive selling sense, and it came right down to support. This is a support level. You can see all the reactions to the left, quite a few reactions around from above and below. And so this is basically just a reaction off support. So there's another one that needs to go, and if and when it goes, I didn't put all my long-term targets, but I would put it right around here somewhere. And I see quite a bit of reactions. I look at the volume at price histogram, and that's about 18% or so. TSM, I said this would be the only stock I talk about because by market cap it is the largest the semiconductor. And here's a trend line. I even have to jump out to 4-year chart here to show you that trend line. Super well defined. A lot of reactions. Again, I've covered this in recent videos. So that's what I'm waiting for, guys. A break on all three of those major semiconductor ETFs as well as TSM. When all three of those have definitively broken below these trend lines with some pretty convincing price action, I think it's safe to say that we have a sell signal in the semiconductors. Final chart, and I'll wrap this video up. For those of you who want to trade it, here's SOXX. And as I mentioned, because of the fact that the trend since the February lows was mostly unidirectional, some zigs and zags along the way, as any trend is going to have, you have a pretty well-defined downtrend line. So in other words, this chart syncs up pretty well, the trend lines and everything else, with the non-leverage ETFs. Now you usually won't see that, especially had the semis chopped around for, go back on your own charts, look at a period where they might have traded in sideways range, maybe that triangle I showed you on SOXX before. But now we have a pretty well-defined downtrend line. It has several reactions here. We have almost divergent low. We never made a lower low, and we didn't make a higher high yet on the semis on the daily. So, but most important, I want to just try to show you some of the targets here. These are all resistance levels. If I have two levels close together, I refer to that as a resistance zone. I'd expect a reaction probably if and when we hit the top of that zone. That's about 18.5%, or I should say the bottom of the zone, because we're basically looking at a semiconductor chart in reverse here, since this is the bearish short ETF. 26% or so to the top of that zone, and ultimately I think we work our way up here. At least that would be let's just call it my preferred swing target now. That's about a 51% gain. Now again, if SOXX does what I think it will do, then we're talking, as I mentioned earlier, at least a 60% gain. So a lot of profit potential here. It'll most likely be added. It's an official trade idea. And for those of you that want to look at the individual semis, I have about, like I said, a little over a dozen short setups, some that look like they're already breaking down, some that have a little more work to be done. And then I have a few longs in case this sector does have another bounce up. There are a few coming down to support with divergence that I'll look at. So I'll go over those for you as well. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.